YouTube, welcome to the asset class overview of cryptocurrency. This is part 2 of a series of videos where I have to go over cryptocurrency because there's a lot to talk about and not a lot of people know about it, so I figured I'd start with the basics. If you have any questions or concern, please leave the video a like and leave those questions and concerns in the comments. I will address them most likely in another video. But essentially, moving away from Bitcoin, we had the block wars going on, as I mentioned in my recent video, where people were trying to sway some of the miners away from the original code of Bitcoin into something that served more as a peer-to-peer electronic cash payment system. And eventually, along the lines, we had somebody named Vitalik Buterin who came in and decided he was going to make a whole brand new cryptocurrency with a whole brand new network. And basically, Vitalik and Ethereum established a new standard for blockchains and the way that they can run. Now, I explained in my previous video that Bitcoin is mined by computers running and solving math problems to solve a cryptographic puzzle in order to provide so that everybody has consensus on these blocks. It gets a little bit complicated in that if you want a specific, there's other videos out there, but essentially computers are mining for Bitcoin, solving math problems, therefore they can all come to consensus and send out blocks every 10 seconds. Now, the way that that has evolved is that computers basically became in an arms race with one another to establish the best video cards and the best hardware in order to mine and solve these math problems faster than their competitors to get more Bitcoin, yada, yada, yada. Proof of work model is great. It relates very well to gold and is very commodity-esque, but Vitalik decided to come in and say, not only is this stupid, but also is very energy intensive and very expensive to maintain. So he decided that he was going to create a new blockchain system called proof of stake. Now, proof of stake, every time you hear that, just think paper asset, because Bitcoin, if it's meant to be digital gold, any proof of stake network essentially functions as a digital company. Now, when you're getting into proof of stake cryptocurrencies, essentially what that means is consensus, rather than being mined through processing power, is merely come to consensus based on nodes. And a node is basically just a ping that says, yes, this transaction is correct, no, this transaction is not correct. And these nodes basically just communicate with each other. And that's basically how they come to consensus. And the amount of consensus power that your node has is based on the amount of the cryptocurrency that is underlying that network. So we're going to use Ethereum as an example, even though I personally believe that it is completely outdated and not going to survive for much longer. Great proof of concept, but Ethereum, much more than Bitcoin, doesn't really have the digital gold angle to grab onto, so I don't think it's long for this world, but the angry people in the comments can debate me on that all long they want. But essentially, what Vitalik did is he said proof of stake with nodes and the amount of Ethereum you have being how much consensus power you had essentially established a far greener method for coming to consensus on the blockchain. The problem with that, though, is that Ethereum became captured and controlled, and it became very expensive and slow and cumbersome to operate on the network, and the powers that be in charge of Ethereum decided that this was okay to maintain because it had the first mover advantage in a lot of different aspects. The thing that set Ethereum apart from Bitcoin, apart from the fact that in its genesis it was faster, cheaper, and more efficient, it allowed programmability and the creation of something called smart contracts. Now, smart contracts, essentially, for lack of a better word, just involve you putting code onto your transactions so that a certain criteria of events have to transpire for those currency units, the Ethereum itself, to be spent. Basically what that means is the most basic form of smart contract that I could say would be like an escrow account. So if you have something on your account, or even better, I would hold Ethereum in escrow for you until you provided some sort of service or action for me. And once that service or action has been done, the Ethereum will be released from that escrow account and put into your wallet. Now, other things that have been invented, like NFTs, at the genesis, there were many monkey pictures and digital art that you could hold in your wallet along with your Ethereum that would represent value, much like artwork would. But whether you believe, I personally don't believe that monkey pictures have any value, but the idea of NFTs as a non-fungible token was essentially something that you could have on your wallet that would have some sort of value at the end of the day. And it started with artwork, but the applications for it are endless. It could be An NFT could represent a key to a private club, or it could represent medical records that are unique to you. Essentially, anything that could be held in your wallet that's not fungible, meaning that it's not like anything else. One NFT is not like another NFT. That's the whole point. Also, what Ethereum allowed you to do is it allowed you to run your own token on top of the network. So that's where a lot of these meme coins come from. And in this video, I'm going to get into why a lot of these cryptocurrencies are not like the others. There are actually many different kinds. Some of them are absolutely worthless and only have any value because it's funny. And some of them actually have real utility based on the smart contract software that they have. Ethereum used to have very competitive and decent value, but nowadays, realistically, it's basically just first mover advantage. It's been grandfathered in, much like Bitcoin was, and there's a lot of vested interest in making sure that Ethereum functions in a way that generates the holders of Ethereum money. But as far as solving real world problems, it gets outclassed. As far as being a digital asset that has scarcity, it's outclassed by Bitcoin specifically, along with a lot of others that have finite supplies, and a lot of them are coming out with reduced supplies. So Ethereum, in my opinion, if you have a specific use for your cryptocurrency, there are better options. If you're buying it as an investment, its days are probably numbered as a good investment. You can see in the most recent market cycle that Ethereum is not doing as well as it has in previous cycles, and that's mainly because other people have built other blockchain systems that just work better, that are cheaper, faster, more secure, and more specifically built for purpose over Ethereum. Ethereum is a great proof of concept, and a lot of the first dApps, which is a decentralized application, which is essentially a application on your computer, much like a video game or Microsoft Word that your computer runs, but it has the D in front of it to represent decentralized, meaning that it essentially operates and with crypto infrastructure, or the Ethereum blockchain, or any other blockchain, because Ethereum established a lot of firsts in the cryptocurrency space, as well as specifically allowing you to make your own token and putting it on top of the chain. So if you ever see a token that's an ERC20 token, that's an Ethereum token, and a token that has been built specifically on Ethereum. There is wrapped Bitcoin, which is an ERC20 token, and it's essentially Bitcoin that has been put into a wallet, and then a private trusted company has gone and made a representation of that token on the Ethereum network so that it can be traded faster and cheaper than it does natively on the Bitcoin network. Now that comes with the same caveats as you holding gold in your hand versus having gold, and an ETF is essentially the difference between Bitcoin on the native network versus Bitcoin wrapped in an ETF or the Ethereum chain. But there are also some tokens that aren't just made for funny. There are things like decentralized applications. One of my favorites is a decentralized exchange, where many of these Ethereum tokens, whether they provide utility or not, can be traded with one another in decentralized manners, and essentially decentralized code can be run based on distributed ledger technology that allows for auctions and market makers to form markets without any third-party intermediaries. It's simply code that runs and does this for you. And the advent of distributed ledger technologies, specifically with dApps, was a huge milestone for the cryptocurrency industry, because it essentially allows for the elimination of third-party intermediaries when it comes to financial transactions, or realistically any application whatsoever, which is where the term Dapp, or decentralized application, comes from. Now, there are a lot of other tokens. The vast majority of people call them layer 1 tokens. Layer 1 token would be like Bitcoin, Ethereum, any token that represents the base chain. And you'll notice that Ethereum and a lot of these layer 1 tokens are worth a lot more than tokens built on top of them, simply because any token operating on top of Ethereum has to use the Ethereum technology to operate, and those fees are paid, and it's the chain's native token, which for Ethereum would be Ethereum. There are others. XRP was one that was specifically targeted at bank-to-bank transfers, but they had some problems with the SEC until recently. There's Cardano, which is very much a grassroots movement of being built by the people for the people, and very much against any sort of centralized interference. Fun fact, Cardano was actually created by one of the people who helped Vitalik create Ethereum. And then there are several others. One of my favorite ones right now is Hedera HBAR is their token, and they essentially use a proof of stake model. A lot of these chains use proof of stake models because they're faster, cheaper, greener than a proof of work chain like Bitcoin. Bitcoin is actually one of the first and I think only real proof of work chains. All of the other ones that came after that were not a massive success. A lot of them have really great intentions, especially because they're trying to emulate gold, but a lot of them just simply don't do nearly as well as Bitcoin has in that regard. And a lot of these chains have the same functionality as Ethereum. So a lot of them have tokens that can be built on top of them. A lot of them allow Dapp functions. Ethereum doesn't necessarily have a solid fixed supply like Bitcoin does. It's more of a managed supply. And the justification behind that was that the supply can be adjusted based on what would be in the best interest of the health of the network. But many cryptocurrencies have adopted the idea of there being a fixed supply because they want their asset to be considered finite, much like a commodity, much like Bitcoin was meant to be. You'll see that ethos carried through to a lot of different chains, and even even tokens that are built on top of any layer 1 protocol. Now, I'm going to quickly touch on layer 2s. They were built to essentially work as a chain that's stacked on top of a chain. They only really exist on Ethereum, and they only really exist to essentially work as a scaling solution for Ethereum. So if you hear the word layer 2, think Ethereum scaling solution. Like I said, my personal opinion, not financial advice, I think that Ethereum, as well as any layer 2 built on top of Ethereum, is just trying too hard to make Ethereum work, and that just relates into there being a vested interest to make Ethereum work. Which is why a lot of the cryptocurrency space calls Bitcoin being digital gold, Ethereum's considered digital silver, because a lot of these layer 2 networks that function on top of Ethereum, that use Ethereum as a base settlement layer, still use Ethereum as a valuable asset because it's still used as a base transactional layer for Ethereum, even though these networks have their own layer 2 tokens that function as their own transactional medium. There are a lot newer chains that function as layer 1s like Ethereum, but have all of the functionality of a layer 2 scaling solution built right into the base chain. And I have a feeling a lot of these chains will be considered the de facto for any sort of real application built on top of them because they have the functionality for it. The only reason you're investing into Ethereum is because you're basically betting that the vested interest in Ethereum maintaining its value is going to continue being able to do that. But as we can see based on the prices, especially with Ethereum compared to other cryptocurrencies, even ones that are lower on the totem pole, Ethereum and its scaling solutions aren't necessarily doing too well. There are other types. So we've gone over Bitcoin, we've gone over layer 1s, layer 2s. There are stablecoins, which essentially people said that it's very difficult to transact or trade Bitcoin from fiat currency, which would be your American dollar or Swiss franc or equivalent, to Bitcoin. There are exchanges that facilitate these transactions, and it became very cumbersome, and a lot of these exchanges employ troll tolls and just fleece the crap out of you to transact between your bank account and Bitcoin. So people decided to come up with a stablecoin, which is essentially a crypto token that its sole purpose is to have its value pegged 1-to-1. The most popular stablecoins are that of the US dollar, so the vast majority of them, if you look at the price chart of a cryptocurrency and it's at $1 and it just fluctuates very heavily around that and doesn't really change its price, it's supposed to do that. It's a stable coin, and it's meant to function in essence as a poker chip, because transacting for another token on the network that's representative of $1 turns out it's actually very useful when you don't want to constantly transfer between cryptocurrency and your bank account, which has become very, very cumbersome and really hasn't stopped being cumbersome to this day to do. So stablecoins serve as your function of getting out of exposure of the cryptocurrency market without leaving the cryptocurrency atmosphere as a whole. And that has proven very valuable, especially for decentralized exchanges that are built on top of layer 1s. You also have exchange tokens, so you'll see like crypto.com or Kronos has a token that's meant to represent the exchange that facilitates the transactions between fiat and crypto, has an investable cryptocurrency, much like a stock. A lot of these cryptocurrencies that aren't Bitcoin are essentially just stocks. And I don't want to say stock in the sense that it's a company, because it's not. And the reason why you're having such a hullabaloo in the executive branches of governments trying to figure out what currencies mean what is because ultimately you are buying equity in software, a network, rather than any particular company. So it's the same as saying like ChatGPT has a stock, and any profits that ChatGPT makes um, is essentially going to be held over and carried over onto this token. But OpenAI, which was the builder and the owner of ChatGPT before they released this token to spread the ownership of the software, is still a sole proprietorship company. As an example, I don't know if it is or isn't, but essentially a company can build a technology and then sell shares of that technology and have those shares not representative of the company, but representative of the software network. There are other tokens called Memecoins, which are funny artwork, and a lot of people think they're stupid and that their value is going to go to zero, but these meme coins end up seeing a lot of the volatility of these price swings in the crypto market, up and downside. And in all honesty, my personal opinion is that these need to be viewed as culture tokens because they will probably never go to zero, purely because people will buy them knowing that they have the full chance to go to zero. They just think it's funny. And people will always invest into fun. If you've ever been on the internet, you know people will just do stupid stuff for the sake of doing stupid stuff, which is why I like to think of these tokens as culture tokens rather than stupid tokens, which is what a lot of my colleagues in the space like to refer to them as. But I at least can identify why they have value and why they might necessarily not go away. And you know, a lot of the people who are chasing these 100x or get rich quick in crypto or trying to do so in meme coins, they're trying to invest into coins that anybody can just make up out of the blue, but if they're funny enough and they go viral enough, they can appreciate in price very, very quickly. And you'll see this a lot, especially during the ridiculous bull markets that you see in other cryptocurrencies. So if Bitcoin goes on a bull run, Ethereum goes on a bull run, and a lot of these meme coins go on a ridiculous bull run, but a lot of these meme coins end up crashing back down to next to nothing or on par with where they were beforehand. If you've heard of Dogecoin, that's essentially what's known as a premium meme coin, which is just stupid, in my opinion. That's where the world is right now, but it's a meme coin that is the most widely adopted stupidity coin, culture coin, whatever you want to call it. And it's probably not going away anytime soon. I'm sorry if that tickles some people or they don't want to be tickled, but that's essentially what's going to happen in that regard. We've covered stablecoins, exchange coins. There are other decentralized applications that run on top of Ethereum that also, on top of not necessarily Ethereum, on top of any layer 1 that aren't necessarily meant to be a blockchain token or a layer 2 scaling solution, but they are still an application that runs on top of this, of distributed ledger technology, and they have a cryptocurrency that's meant to represent the value of the software that runs on top of the cryptocurrency. Like I said, there are decentralized exchanges that can be built on top of layer 1 networks that facilitate the transactions of the tokens on the network with one another, and these DEXs, as they're called, have their own tokens to represent essentially a portion of the value or the transaction fees that are swapped on these platforms. So some cryptocurrencies actually do really have value, and the onus is on you to actually delve in and look at whether a cryptocurrency is a layer 1 blockchain solution, aka the native layer of a distributed ledger technology. Those inherently have very much value because anyone building on that network has to use that token as their gas fee. So that's why you see them as the most valuable of most of the crypto assets. There are some meme tokens or tokens built on top of the networks that aren't actually memes. They're meant to represent technology that actually generates profit and uses the distributed ledger technology facilitated by these layer 1s to do so. And then again, there are other tokens that its value should absolutely be zero, and the only reason that they have value is because they're funny to look at. There are other cryptocurrencies that are meant to peg themselves to an external commodity or asset, like a US dollar stablecoin, a stablecoin in general. They are trying to make others, such as stablecoins for gold, but these essentially just function as ETFs, but in the crypto space. And then there's Bitcoin, which is digital gold, and most crypto layer 1 networks will have wrapped Bitcoin on their network, like I said in the previous video, because there's no other cryptocurrency that's going to be grandfathered into every other network. That's basically a rough overview of cryptocurrency, and there's a lot to dive in. The space is ever changing, and the onus is on you to make sure you're doing your research as to which cryptocurrency you're buying. 99.9% of cryptocurrencies will fall under one of the categories I have posted in this video. I'm most likely going to make several videos in the future on cryptocurrency, so keep in tune for those, but this has just been a general overview of the asset class, and yeah, guys, look forward to making videos for you in the future. Take care.